Your phone buzzes. A stock you've never heard of is suddenly up 80%. The news says the company could transform an entire industry. TikTok says it is the next Nvidia. Your friend, who discovered investing approximately 3 business days ago, is already calculating which Lamborghini he wants. So you open your trading app and buy. Then the stock drops. And suddenly, the person who said, "This is going to the moon," has deleted the video, changed his username, and apparently become a fitness influencer. But here's the question nobody asks while everyone is rushing to buy. Who is selling? Because every share you purchase comes from someone who has decided that this is a good time to let it go. So when a stock finally reaches the headlines, are you discovering an opportunity, or are you becoming the opportunity for someone who arrived before you? By the end of this video, you will understand why stocks often move before the news reaches you, how public attention creates exit liquidity, and the 5 questions that can help you recognize when excitement is turning into a trap. So, is it already too late once a stock reaches the news? Not always. Real news can create real opportunities. A company can launch a successful product, enter a new market, or report results that completely change its future. But once everybody is talking about a stock, one thing is certain. It is no longer undiscovered. The market may already have spent days, weeks, or months anticipating the announcement. Early investors may already be sitting on large profits. The headline you are seeing might not be the beginning of the opportunity. It might simply be the advertisement for something that has already happened. And that difference between receiving new information and receiving popular information is where many investors get trapped. There are thousands of publicly traded companies. You cannot research every one of them. You probably cannot even name 100 without eventually inventing a company called American Technology Incorporated. So your brain takes a shortcut. It pays attention to stocks that are already moving, the company appearing on television, the stock trending online, the one your friend claims he's almost bought before it doubled. Researchers Brad Barber and Terence O'Dean studied this behavior and found that individual investors were more likely to buy stocks that attracted attention through news coverage, unusually high trading volume, or extreme price movements. That makes sense. When choosing what to sell, you only need to examine the stocks you already own. But when choosing what to buy, you are selecting from thousands of possibilities. Attention reduces those thousands to the 5 names currently occupying your screen. It is the stock market version of a supermarket, placing expensive products directly at eye level. You believe you selected the product, but first somebody selected what you would see. Professional investors are generally less dependent on this process. They have analysts, screening systems, financial models, an entire team searching through companies before those companies become popular. You opened your trading app during lunch, they have a department. The stock market does not simply measure how well a company is performing today. It measures what investors believe the company will do tomorrow. Imagine a company is expected to earn $1 billion. Before its earnings announcement, investors become optimistic. They buy the stock, pushing its price higher because they believe the company will exceed expectations. The company finally reports a record profit of $1.1 billion. Excellent news. But the stock falls. Why? Because investors had quietly expected $1.3 billion. The company performed well, but not as well as the price had already assumed. This is why you sometimes see headlines saying, "Company reports record-breaking revenue." Then directly underneath, shares fall 12%. It feels as if the stock market has become angry at success. But the market is not reacting only to the result. It is reacting to the difference between the result and the expectation. The opposite can also happen. A struggling company reports another loss, yet its stock rises because the loss was smaller than investors feared. The headline tells you what happened. The price tells you what the market expected to happen. And by the time the headline appears, thousands of traders may already have positioned themselves around that expectation. That is the meaning behind the old market phrase, buy the rumors, sell the news. Investors buy while an event is still being anticipated. Then once the announcement becomes public and attracts new buyers, some of those early investors take their profits. Suppose an early investor owns $10 million worth of a stock. The stock has risen significantly, and the investor wants to exit. There is a problem. You cannot sell $10 million worth of shares unless enough people are willing to buy them. Trying to unload everything into a quiet market could push the price down before the entire position has been sold. But then the stock reaches the news. Television stations begin covering it. Social media fills with price predictions. Trading volume increases. Thousands of new buyers arrive. That excitement creates something extremely valuable: liquidity. Liquidity simply means there are enough willing buyers and sellers for large trades to happen more easily. The new buyers are not necessarily being scammed. The sellers are not necessarily evil billionaires stroking cats inside a dark office. A seller could be an early investor taking profits, a fund reducing risk, a trader completing a short-term strategy, or an institution rebalancing its portfolio. Selling is a normal part of the market, but the important lesson is this: a wave of public excitement does not only help the people rushing into a stock, it can also help the people who are waiting to get out. The modern stock market does not run only on company reports and financial statements. It also runs on attention. And social media platforms have discovered that fear and excitement generate more engagement than calm analysis. Here's a reasonably valued company with moderate long-term potential is probably responsible. It is also a terrible TikTok hook. This stock could explode 900% before Friday is far more clickable. The algorithm does not know whether the information is financially intelligent. It knows that people stopped scrolling. That creates a cycle. A stock starts rising. The rise attracts attention. The attention produces videos and headlines. The videos attract new buyers. The new buyers push the price higher. The higher price becomes another headline, and that headline attracts even more buyers. For a while, everybody appears correct. The early investor is in profit. The influencer's prediction is working. The new buyer believes he has discovered a talent previously hidden from the global financial system. But rising prices alone do not prove that the company has become more valuable. Sometimes the story improves. Sometimes only the attention improves. And when the supply of new buyers begins to disappear, the price can fall much faster than it rose. Not every popular stock is manipulated, but public excitement can be deliberately manufactured. In a pump-and-dump scheme, promoters accumulate shares, spread exaggerated or false claims to create buying pressure, and then sell after the price rises. The people buying near the top are left holding shares that may be worth far less once the promotion ends. This is why phrases such as these should immediately make you cautious. Guaranteed returns. Insiders are loading up. Last chance before it explodes. They don't want ordinary people to know. Who exactly is they? The government? Wall Street? Your neighbor who works at Walmart? Vague enemies make excellent marketing because they allow promoters to make followers feel as though they have discovered forbidden information. But genuine investment research does not require a conspiracy to sound convincing. It should be able to explain the company, the numbers, the risks, and what could prove the argument wrong. This does not mean institutions possess a magical crystal ball. Professional investors lose money too. Funds miscalculate. Analysts misunderstand companies. Large investors can buy at the top, sell too early, or become trapped in the same hype as everybody else. And a stock appearing in the news does not automatically mean it is about to collapse. The real lesson is not never buy popular stocks. The lesson is do not confuse popularity with value. A good company can still be a terrible investment if its price already assumes perfection. And an unpopular company can still be a terrible investment because sometimes nobody's buying it for a very good reason. The goal is not to automatically follow the crowd or automatically oppose it. The goal is to understand what the crowd is paying for. Before buying a stock that is suddenly everywhere, ask 5 questions. First, what changed in the actual business? Not the chart, not the number of people talking about it. What changed in the company's revenue, products, customers, costs, or long-term position? If the only answer is the price is going up, you do not have an investment argument. You have a description of the chart. Second, was the news unexpected? A positive announcement can already be included in the share price. Ask whether the market has been anticipating it and whether the company delivered more than investors expected. Third, how much future success is already priced in? A company might genuinely have enormous potential. But if the stock price already assumes years of perfect execution, even a small disappointment can cause a major fall. Fourth, who is promoting it? Do they explain the risks? Do they disclose whether they own the stock? Are they analyzing the business, or are they repeatedly shouting a price target while dramatic music plays behind them? And fifth, what would make you admit you were wrong? Before buying, establish what evidence would invalidate your argument. Otherwise, every decline becomes a discount. Every warning becomes fear, and eventually you are not investing. You are emotionally supporting a stock as though it is your struggling football club. These questions cannot guarantee a profit. Nothing can, but they force you to pause long enough to separate analysis from excitement. The most dangerous moment in investing is not always when nobody knows about a stock. Sometimes it is when everybody suddenly does. Because headlines create attention. Attention creates buyers, and buyers create liquidity for whoever arrived first. That does not mean the stock must fall. It means the game has changed. You are no longer buying an unknown opportunity. You are buying something surrounded by expectations, emotions, and people who may have paid much less than you. So the next time a stock dominates the news, do not begin by asking, how high can this go? Ask the question that reveals the entire system. If everyone is rushing to buy, who is selling?